In this video, I want to cover 4 things that you should think about if you're considering signing on the dotted line to buy your dream vacation home or your retirement home. Welcome back. This is episode 164. With home interest rates recently hitting 20-year highs, you may be wondering if now is a good time to make that purchase of your retirement home or your second home. And in this episode, I'd like to talk about some things that you should consider before signing on the dotted line to make that purchase. And if you're new to the show and you want to plan the ideal retirement, then consider taking my comprehensive retirement planning course that you can do online that's called Retirement Readiness Review. And I'll walk you through all the steps that you need to go through to make sure that you're planning the perfect retirement. So to learn more about it, head over to retirewithryan.com/on-demand, and you can then sign up to go through this course at your own pace. According to a recent article that I read on Yahoo, 2/3 of wealthy Americans are now an owner of a second home, and the other third that doesn't own a home is actually considering making that purchase. So before you go ahead and make that purchase, I want to talk about things that you should consider. So let's first start with where we are. As I mentioned earlier, interest rates hit a 20-year high. That means if you're looking to take out a mortgage, you're going to be paying more than double than what you would have paid roughly 3 years ago. The 30-year fixed mortgage rate is currently around 7.6%. And 3 years ago, you could get a 30-year fixed rate for around 3%. And many of you probably were able to purchase a home and take out a mortgage of 3% or lower, or maybe even able to refinance. So a lot of us are not quite comfortable yet with paying these higher interest rates, but we do know, going back many years, that it was very common to have interest rates 7-8%, if not higher. So additionally, there's short supply of homes to buy. Because a lot of people were able to refinance or purchase a home in the last 3 to 5 years at a low interest rate, they're not very interested in the idea of selling their house and moving into another home where if they need to take out a mortgage, they're going to be paying much higher borrowing costs. So between that and just the short supply of real estate that's out there, it's causing a lot of people to stay where they are. So secondly, is it a good time? Well, it's always hard to time any financial market, whether that be the stock market or the real estate market. It's hard to know whether or not home prices are going to continue to go up or they're going to go down. And we do know that on average, the average home price is about 30% higher than where it was pre-COVID. And there are many areas, especially vacation and warmer climate states and areas, where the prices have gone up even more than that. Some have doubled. So if you could avoid it, I would definitely say if you didn't have to purchase a second home, you may want to sit tight and see what happens with home prices. What goes up probably will come down. It's hard to say when. We do know that mortgage rates, if they go lower, that might help to stimulate some more inventory that's out there, and that might actually lower the price of homes. So it's hard to say, but if you're in a position where you want to buy the second home, you've been waiting to do it, this was part of your financial plan, part of your plan, well, it may not make sense to wait because you might want to start enjoying that home now. And if you do end up buying a home now, even at a higher interest rate, and you're planning to stay there for a long time, that's okay. You'll probably have another opportunity down the road, hard to say when, maybe the next 5 to 10 years, where you could actually refinance that mortgage at a lower rate. So it is possible that it can make sense for you if you're looking to do it as a longer term play. If you're looking to do it as an investment, as a speculation, then I could see it not making as much sense. So as far as how do you actually finance it? So one way, which we've talked about a little bit, is you could use a traditional 30-year mortgage. That's going to be the most straightforward way. You'll talk to your bank or a lender and find out what you'd be approved for. They'd run your credit, look at your other debt that you have, and give you a quote as far as what you'd be paying. You can also go the non-traditional route, and you could use a non-traditional mortgage like an adjustable rate mortgage. Unlike the fixed mortgage, the adjustable rate mortgage has a period where the rate is fixed. It might be 5 years, it might be 10 years. So the interest rate would be fixed during that period. And then after that, the interest rate would adjust every 6 months. So if you thought interest rates were going to go lower in the future, you could use one of these products. with the belief that your rate would go lower in the future, or before the rate lock, so the 10 years, let's say it was a 10-year ARM, adjustable rate mortgage, expired, you could refinance into a lower rate, then that can make sense. There is a little more risk with that, because if you're not able to refinance before the rate goes higher, you're going to be paying a higher payment. So you have to be aware of that. You also could use your existing home equity to finance the transaction. You could do something like a cash out refi, or you could take out a home equity loan or a home equity line of credit. That's another way to tap into your existing equity you might already have. Or if you have a significant portfolio of stocks or bonds or other investments, you could use a portfolio loan. Different brokerages will connect you with different lenders. You're generally going to pay a higher rate than you would on a traditional 30-year mortgage or even adjustable rate mortgage. But if you don't want to go through the process of applying for a mortgage and collateralizing your home, you can collateralize your portfolio. It still comes with risks. If the portfolio drops a lot in value, you might be forced to put more money into the portfolio or sell things to cover your loan. So there are pros and cons with that, but it is another way to do it. So lastly, what are things to consider before you begin the process? If it still makes sense for you and you want to go forward with buying the second home, what do you need to consider? Well, I would always suggest going back and listening to episode 12 titled Buying a Second Home, because in that episode, I cover in greater detail some of the tips that I would have before you actually make that application. So first thing I mentioned there is, do you have the money for a down payment? Buying a second home can usually require at least 10% for the down payment, and it could even require more. So be aware of that. You also want to shop and talk to different lenders. Mortgage rates differ from lender to lender, and you probably want to talk to multiple lenders to find out what their packages that they offer, and also what financing or lending fees do they charge, so that you've shopped the market. Next, you have time to apply for a mortgage. I don't know if you've applied for a mortgage lately, but it's quite a process. You have to supply a lot of information, pay stubs, tax returns, investment reports, and just when you think you're done, the mortgage company will usually ask you for more information. So it is a process. I would say at least 5 to 10 hours it's going to take of your time just to apply for the mortgage. And the more properties and the more businesses and complexity you have, the more time it's going to take. So make sure you have the time. And then whether or not you want a vacation at this property, yourself, or you want to rent it out, you'd also want to decide if you want to do that. So you could do some research as far as how often can you rent the property out, what could you potentially get in rents. But I would say if you want to be on the safe side, just assume that you're not going to be able to rent this property out at all. And that way you know that you're going to be able to cover the costs, assuming no rental. And if you are able to rent it out, then that's just going to be some extra income that you're going to be receiving. And if you are going to rent it out, are you okay being a landlord? A lot of people, the idea of being a landlord sounds like fun, but it is work, and you want to make sure that you're comfortable doing that if you plan on renting out the property. Next, make sure that you're anticipating annual repairs and maintenance. If you're buying something like a condominium, it can be a little bit easier to predict what the maintenance will be because you know what your monthly expenses are. But be aware, condominium and maintenance fees can go up. One of the big things that's happening, unfortunately, in a lot of areas like Florida, where we have that horrible building collapse, is that maintenance fees are going up because they're requiring condominiums to have a greater reserve account. So in some instances, people's condo and maintenance fees are doubling and tripling. So be sure that if you buy a property and there's an increase in these fees, that you can actually consider you can continue to afford it, because you don't want to buy something and then find out you can't afford it, or you can afford it only by being house poor, in the sense that you can't do the things that you want to do in your retirement, like traveling or entertainment. So make sure that you have some flexibility there. And while we're talking about affording it, be aware that many lenders are going to require that your debt to income ratio be 43% or below. So that means any debt payments that you have to make, other mortgage payments, car payments, other loans, divided by your income is less than 43%. So if it's more than that, chances are you're not going to be able to afford this vacation property. So just some of the things that you should consider. It can still make sense. Just be aware that most likely you're paying a very high price to buy that home. Could prices go higher in the future? Certainly. But we also could see a correction in the housing market as we did in the mid-2000s, 2005 to 2008. So if we do go through that again, just make sure that you're okay if you pay more today than maybe your house is, or your second house is worth 2-3 years from now. If that's okay with you because you're planning to be there a long time, then go forward. But if you're looking at this as an investment property, be very, very cautious and very skeptical about doing that. So I hope this episode was helpful. As always, if you have a listener question, head over to retirewithryan.com and you can propose your listener question there. Have a great week, and I look forward to talking to you next Wednesday. Take care.